Alright everyone, we are back. Make sure you check in. Everybody check in over here. Cameras on, please. Alright, very good. 21 people. Come on everyone, make sure all of you check in so we can start. Cameras on, please. Very important. "24 attendees, we had 30, so make sure everybody checks in, please, so we can start. I gave you more than enough time to go and come back, right? Joanna, you don't have to get into the camera. I almost felt like you're coming to this side. It's like the camera all the way in. Here, give me your phone, Joanna. Give me your phone. I'll get it. I'll get it. Chrissy, really? I'll take the dog. No? All right, 26. 4 more to go. Come on. All right, 2 more to go. On everyone. I just got a message like teaching first grade. Yeah, actually worse. Adults are worse than children. All right, who did not check in yet? Let me start calling your names. All right, Jaquana, where are you? I don't have a check-in yet. Patricia, where is she? All right, we're moving forward. Yep. All right, mortgage market. So, first of all, what does this word mean? Market. Who can tell me what market means? Answer is where buyers and sellers interact. All right, I don't know about the interaction. Where buyers and sellers interact. Place where things are bought and sold. Where buyers match with sellers. Katya said master plan. It's market, not master plan. Okay. Wafa wrote O. I don't know what O. I don't know if it was O or 0. I'm not sure. Tatiana said plan. Gloria says availability. Carla says come together. Right now. Yep. There's a song for that too. Right. And Stacy says advertise. Arja says a store. Tatiana says a place. Okay. Located real estate or sell or buy. All right. If there's anybody watching on YouTube, let me know. Whoever's there watching YouTube, let me know what you guys see because I just got somebody texting me saying there's a black screen, like nothing showing up. I just want to make sure it's going through. If you're watching on YouTube, let me know if the stream is good. Thank you. All right, so markets. The market is where things are bought, sold, or traded. Okay? So every time we're talking about market, that's what you need to remember, where things are bought, sold, or traded. We talked about that when we said real estate economics in markets, right? So in this case, it's mortgage markets. So when we're saying where things are bought, sold, and traded, if it's the mortgage market, then it's where mortgages are bought, sold, or traded. Okay? Hold on. I just want to make sure YouTube is working. I got 3 people watching on YouTube. Let me know you guys are there if you can see me or not, please. 4 people. I want to know if it's working. All right. So, mortgage market, supply and demand for money. Let's start with that one. So, the mortgage loans provide borrowers with funds to purchase real estate. Money for mortgages primarily come from cash savings of individuals, government, and businesses. Diana, thank you. Okay. All right. Jaquana just wrote, I want to kill my kid. That's what I just saw here. And I have the code. Sorry. Kid's a terror. I see that. I already know. I'm going to spank him. I'm going to throw him somewhere. Somebody take him, please. All right. That's what I just read. Is that it, Jaquana? No? All right. Let me give you the code for you to send in. Look, there's always kids' cages. Just ask the government. They'll know. Okay. No? Too soon? All right. Moving forward. I know, bad jokes, but always a joke. Okay? Nothing serious. Don't ever take serious what I say, other than the class itself. All right, so here's what we got. This money may become available through the process of hashtag free Bruno's kids. Yeah, they suffer. I'll let you know right now. They suffer. I keep them in line when I'm home. When I'm not home, they do whatever they want. Like the wife has a filter already. She can filter the noise. So I don't. Jaquan, how old is your kid? How old is your kid? And L, but 1 year old. Okay. The only one? The only kid you have? Oh, okay, that's why. Once he reaches like 3, 4 years old, or if you have a second kid, then you're able to like filter the. You're done. That's it. One kid, you're done. That's what you say. All right, moving forward. So this money may become available through the process of intermediation, in which funds on deposit with financial institutions are loaned out to borrowers, or disintermediation, in which the owners of savings invest their money directly by making loans or other investments. Government actions and investors' activities affect the supply of money for mortgage loans and encourage or discourage the market for mortgage loans as an investment. Oh, sorry. I for some reason I went to the chat. I don't know why, but anyway, moving forward. So money is a limited commodity, right? So if it's a limited commodity, that means there's not enough money out there, except for the United States, where we print money like it's water, it just flows, right? We print whatever we want, right? Oh, Chrissy's dog, meet Douglas' cat. Douglas has his cat on the screen. All right. So, subject to the effects of supply and demand. You guys remember supply and demand? If there's too much supply of something, not enough demand, what happens to prices? Goes down. If there's not enough supply and there's a lot of demand, what happens to prices? Goes up. Right. So there's a cost also to supply and demand of money, right? If there's too much money out there, then, and there's not enough needs, then it drops the amount of money they can borrow. If there's not enough money, then it increases the cost of borrowing money. So the federal government's monetary policy controls the supply of money in order to achieve the country's economic goal. If there's an excessive supply of money, usually causes interest rates to fall and consumer prices to rise. Conversely, isn't that what we've been noticing? Prices are going up, interest rates have been going down, right? Conversely, an excessive demand for money, let me clear all this out. An excessive demand for money, such as for mortgage loans, causes interest rates to rise and prices to fall. So the opposite. Now, regulation of money supply addresses these fluctuations with the aim to control and limit wide swings in supply and demand cycle. Again, the cycle that we talked about. These efforts, in turn, help buffer the economy from severe inflationary or recessionary trends, right? Now, regulating on in the state for years. Must be, oh, you guys are talking amongst yourselves? Okay. So Jaquana, you'll get in the state for years, must be returnable. So it's a limited lease. There you go. Very good. Very funny, and it applies. Regulating the money supply. Who regulates money supply? The Federal Reserve. How do they regulate the money supply? By 3 methods. One of them is by selling or repurchasing government securities, primarily treasury bills. By changing the reserve requirement for member banks. By changing the interest rate or discount rate. So member institutions, members of the Federal Reserve, let's say Bank of America, for instance, they borrow money from the Fed. They borrow money so they can lend you money. That's one of the ways. Or they sell whatever loans they have, active loans, they sell to another entity in order for them to lend more, right? Now, when the Federal Reserve sells treasury bills, the money paid for the securities is removed from the economy's money supply. Conversely, when it repurchases treasury bills, the cash paid out to investors puts money back into the economy. The second control is regulating the reserve requirements. What does that mean? How much money banks can put into the economy through the disbursement of loans. So for instance, if I have $100 million to lend, as an example, I have to keep a reserve. The reserve could be 10%. The reserve could be 5%. They'll change that reserve requirement depending on how much money is out there, how much money is needed, and whatever it's safe for the banks and for the economy, right? So let's say it's 5%. So it's 5% of 100 million. So the banks must keep in the bank $5 million, and they lend out the rest. Okay? So that's the way Federal Reserve System works. They see it as, hey, as long as you got 5% or 10% in the bank, right, and you lend out 95% or 90%, you're good. Because most people will give that money back by paying, right? Or so we wish. Okay, so that's what it is. Now, the third control, perhaps the most effective, is the regulation of the discount rate in which members must pay to borrow money. If the discount rate goes up, it becomes more cost prohibitive to borrow. Therefore, the money supply tightens. If the discount rate is lowered, banks have an incentive to borrow more money to lend to customers. During the recession, that discount rate, let me clear this out. The discount rate was 0%. So banks were borrowing money at 0%. Now, when the economy got a little bit better, they raised it to 0.55%. Not bad, right? Imagine if you could borrow money at 0.55%. Isn't that cool? Imagine that you can borrow $100 million at 0.55%. Yeah. So this is how they borrow money, at literally free money. Literally free money. But anyway, we pay for that. All right, so the Federal Reserve controls the market. You guys already know that. Now, what market? There's two types of markets. There's a primary mortgage market and there's a secondary mortgage market. The primary mortgage market is what we're going to talk about now. And what I want to ask you guys is very simple. Everybody should know. So all 30 of you should know the answer for this, which is, what are the primary colors? Real estate, mortgage, why primary colors? I see those faces. Why? I don't even remember this. Jaquana's like, my kid's not even old enough to go to kindergarten for me to remember this stuff. I know that's what you're thinking. Right? Red, white, and blue. What are we, the American flag? Red, white, and blue. Oof. Oh my God. Not even... Shame. All right, class is over. These answers? Come on, what's wrong with you guys? Sandra goes, money. That's your answer, money. That's the only color I need to know. Forget everything else. Tanya, thank you. Tati with a question mark, I won't give you that answer then. It's red, blue, and yellow. Okay? White is not a primary color. Black is not a primary color. So it's red, blue, and yellow. In fact, magenta, cyan, and yellow. Those are the primary colors. Oh, thanks, Katya. Like putting it on the screen is better. Should have known, not research. Like, watch, my phone has it. All right. Tracy, that's what I said. Let's investigate. Let's investigate real quick. Okay, there you go. Fine. After research, she got it. All right, so I don't care if you know the primary colors or not. It's not like we're going to do anything with it. But what I want to know, I'm a hairdresser. Oh, so you're a hairdresser, so you know the primary colors? Because you're a hairdresser? How does that work? You're painting people's hairs with the primary color? Is that what you do? Cool. The other hairdressers here, why was your answer incorrect? All right, why do we need to know about primary colors? What do primary colors do, guys? Let me know what they do. At least that you should know. What do they do? Primary colors. They make secondary colors. So why do we need to know primary colors and secondary colors when it comes to mortgage? Here's what you need to know. Very simple. The primary mortgage market, it's where loans originate. Where loans originate. Simple. Primary colors are the ones that originate everything else. So the primary market is where loans originate. So it's not where loans are bought and sold, it's where the lender lends money to you. Okay, that's the primary mortgage market, where loans originate. Okay. So right here, primary mortgage market consists of lenders who originate mortgage loans directly to the borrowers. Gotta remember that. Loans originate. All right. Now, the primary mortgage market lenders includes, if you want to get a loan, where do you go? Well, savings and loans associations, commercial banks, mutual savings banks, life insurance companies, mortgage bankers, or credit unions. All right, so here's the thing. A lot of people think that, oh, I need a loan, so I'm going to go to Bank of America. Not always. See, Bank of America has their own guidelines. So maybe going directly to Bank of America or going directly to Wells Fargo or going directly to TD Bank or Chase or any of those big banks, right? Maybe it's not the best option. Think about it. If I go directly to a lender, I'm not saying that this is always the bad thing or vice versa. But if I go directly to the lender, guess what they have to offer? Their own products, right? If I go to a mortgage broker or a mortgage banker, which banker means they can lend their own money, but if I go to them, the difference is most of the times they either lend their own money, if it's a mortgage banker, or they can also broker the loan, so they can shop around. Sometimes, not always, it might cost you a little bit more, or other times it might cost you a little bit less. Why? Because they have the ability to shop around. If you go directly to Bank of America, guess what? They only have their own product. It's the same thing, it's the same reason why I'm not a captive agent for insurance. Meaning, I don't work for Prudential, but I can sell you Prudential policies. Okay? I don't work for AIG, I don't work for Voya, I don't work for any of them, right? But I can sell you those policies. I work with 150 companies, right? The reason being, I make less commission per sale, but I have more options to give my clients versus forcing down their throat, oh, this is the best product for you because it's the only product I can sell, right? So I prefer to get a cut on my commission, but give you more options and get the referrals all day long, right? Versus forcing you into a product that somebody tomorrow is going to get you out of, and I might have to return my commission. That's what happens in insurance, right? If it's within a certain period of time, I might have to return the commission, right? So for mortgage is the same thing. There are times, I'm not going to say again that mortgage bankers are the best. I'm not going to say going to your bank directly is the worst. There are times, and I've seen this, where I had a loan with a client of mine with Santander, and their loan with Santander was way better than anything that was on the market for that particular client at that particular time. Right? So again, I'm not saying that they're the best or the worst. What I'm saying is if one bank denies you, have a bunch of other places that you can go to get approved. That's pretty much what I'm saying. If they say no to you, don't feel like, oh man, I really wanted to buy a house this year. You might still be able to. Look for the other options. If they all say no, or you have a wide range of them that say no, maybe it's not the best time right now. There's something to fix in your credit. Bottom line, always work with somebody you trust. Don't just go to your bank because that's where you bank, right? You might have checking with Bank of America, but hey, Santander has a great program. Or you have you bank with Santander, and hey, maybe TD Bank has the best for you. It's not where you bank that's always going to be the best rate. Okay, so think about that. All right, Ingrid, I saw you. What else? Maybe a little off topic. The Anna says, what is a credit union and how is it different from a bank? So let's go over them. Let's see, does it talk about credit unions? No. Right, so credit union. Member owned. So for you to be part of a credit union, Anna, for you to be part of a credit union, you must become a member. So it's member-owned banking. So that means that if they make money, okay, hey, Anira, I see you there. So if they make money, if the bank makes money, then you're entitled to what's called dividends because you're part owner of the bank. That's what the credit union is, part owner of the bank. Okay, that's the only thing. The biggest advantage of a credit union is that they have their own regulations. So interest rate sometimes might be a little bit more higher, but they're flexible with their options for you, right? Where commercial banks like a Bank of America, Wells Fargo, and so on, they fall under what we're going to talk about later, warehouse lending agencies, which intend to sell. So they lend to you with intention of selling already to the secondary market. So that means they have very strict guidelines of what they can lend. Above a certain or below a certain credit, they don't lend. Above a certain amount, they don't lend. So you're being rejected because you don't fall into a sellable loan. And that's why we look for what's called portfolio lenders. I'm going to talk about that in a second. All right, so mortgage brokers. When you see mortgage brokers versus mortgage bankers, here's the difference. Mortgage brokers are like us in the mortgage world. We are realestatematch.com. They are mortgagematch.com. Realestatematch.com, why? Because we match the seller to the buyer, right? Or landlord to the tenant. Mortgagematch.com, why? Because they match the lender to the borrower, okay? All right? So mortgage brokers, they do not lend directly. They shop around. That's pretty much what they do, and they match the borrowers to the lenders. Okay? All right, portfolio lenders. Remember I said commercial banks, for instance, they usually tend to sell to the secondary market, like Bank of America, Wells Fargo, and so on, the bigger banks. They intend to sell secondary market. Right. A portfolio lender, like a credit union most of the times, okay, what they do is they intend to hold on to the loan for the remainder of the lifetime. So if it's a 30-year loan, you're going to see mom and pop credit union, right? Mom and pop credit union for 30 years. That's the one that's going to bill you. It's not like you close with Bank of America and then tomorrow Chase is collecting from you, right? No, a portfolio lender, It could be a mom and pop credit union. It could be a mom and pop. When we say this, these are usually the smaller banks, like Hudson Savings Bank, for instance. They don't usually sell it out. They keep in house. They're portfolio lenders. They keep in house, right? So these are lenders that retain the investments. They originate loans for the purpose of retaining them in their own portfolio. They do not sell the loans into the secondary market. Okay? Every time you see portfolio lenders, what is a portfolio? It's whatever I have done or whatever I keep. Portfolio, right? So they don't send in the secondary market. The advantage of portfolio lenders, again, is they are less restricted by standards and forms imposed on other lenders by secondary market organizations. Okay? In retaining their portfolio loans, portfolio lenders may vary underwriting criteria or risk assessment criteria and hold independent standards for down payment requirements and the condition of collateral. So like I said, portfolio lenders, because they keep it in-house, they're way more flexible than other lenders that intend to sell in the secondary market. Now, the ones that sell in the secondary market, their interest rates might be better, but they're stricter in who they lend to. Okay? Ingrid, is it better to use a bank or a broker? Depends. That's what I was trying to explain. Right now, because interest rates are so low, I wouldn't see much of a difference. I still prefer to work with mortgage bankers, but I don't see much of a difference in terms of going directly to your bank or not, to a commercial bank or not. Only because the difference is going to be like, let's say, a fifth of a point or something like that. It's like minimal difference between them. In large scale loans, makes a difference. In smaller scale loans, doesn't make a difference at all. Maybe what, $50 that you're going to save a month, if anything. And the process is a lot easier or faster with a bank than it is with these portfolio lenders. So the criteria is different, but they look for more stuff to protect their own, right? While a bank is like, hey, I'm going to sell to the secondary market as long as you're approved by these guidelines, which is called DU, or desktop underwriting, or LP for loan processing, and I'll explain that better later. As long as you pass whatever is the stress test on the computer, you're good to go. I'm lending to you. That's it. Right? So is that a better one? Right now, it's not like big difference. Okay? Anything to say, Edith? Since you work directly for the bank, what's your opinion? Honest opinion, not the I work for the bank opinion. All right, your honest opinion. Let's go with that. That's what I try to do. I work for New Direction Realty. That's my company as well. But I don't recruit. I give you my opinion based on what I see out there from other agencies, and that's what I can tell you. Right? So I always like to go around. The Edith just said mortgage broker. Okay, that's the honest opinion, and she works directly for the bank. Again, right now, Edith said on Friday said 2.75% is the interest rate that she has for a 30-year mortgage, right? But then you look at the credit, and you don't have to stipulate now, Edith, that's totally separate. But then there's the credit requirement. What does your credit score have to be at for you to have a 2.75? The mortgage broker or mortgage banker will be able either to lend or broker out your deal, right? And maybe your credit score is not as important. So it could be as low as, let's say, 620 as an example, right? Edith's program might say, hey, 620, we're not touching. Don't look at me, we're not touching. We'll give you the 2.75 if you have a 740 score, but at 620, not touching. 700, there you go. Are you guys understanding this? So there's no, my opinion, there's no better one. It depends on your situation. So if you tell me where you at and listen, sit down with several people and see what they have to offer. That's the thing about TILA, right? That's so important that people understand. TILA allows you to shop around. You don't have to stick to one entity. You could go to several entities and see which one gives you the best rates. That's why APR must be disclosed, right? Do you guys understand this? So there's no one better. It's, whatever it's best for your particular situation. I'll take them all. Absolutely, Edith. Why would you put that in the chat for everybody? That's a private thing. Send them all to me, not to everybody. I'm hungry. I'm starving. You're going to give to everybody else? All right. Let me just show you what she wrote. Not even a question. Right? It's not even the question. Guys, build relationships with loan officers. Very important, because you're either going to refer to them or they're going to refer to you, or vice versa. Do make sure you are loyal. I've seen this happen. It happened to one of my agents not too long ago. An agent tried to steal the client. Now, not the buyer, right? But the borrower. What does that mean? The buyer was approved with a particular mortgage company, right? And the listing agent said, hey, tell your buyer that if he works with our mortgage company, like, wait a minute. Why would you tell my client, like, we're not even under contract yet, we just put an offer. And if they work with your lender, things will be way easier and way better. Like, if I start doing that, then where's the loyalty to my people? You understand, guys? Be loyal, because they will be a never-ending source of referrals, right? Loan officers, CPAs. CPAs know everything about their clients. If they have a house, if they don't have a house, if they intend to sell a house or buy a house. Referrals, right? Think about it. If Indeed has somebody that's pre-approved, ready to go, no question. Let's go look for houses, right? That's all you have to do. Why would you take that client and then be like, oh, okay, forget Indeed, listen, I can get you somebody else better, right? You have to look for your client, I understand, but that's the referral. Simple. All right, that's very, very important. Indeed, thank you for putting that out there. Let's see. Joanna says, what about online banks that do everything online? Sometimes they're good, sometimes they're bad, like Rocket Mortgage type of thing, right? Or Lending Tree or whatever it's called. They're brokers, they're not lenders. There might be some lenders because things are changing or have changed recently. So there's one called, I think, Loan Depot or something like that. I have not dealt with them directly. I have a client that was able to, not my direct client, one of our agents' client. He bought a house with these people, and with a loan coming from these people, it was not that bad. I don't know. I still like that face-to-face personal thing. The online thing, like right now, guys, I can reach more people because I could never have the amount of people I have online. I can never have them here, especially now during the COVID. But I like it and I don't like it. I like to build relationships, and Zoom kind of keeps that distance, and sometimes not the best thing, right? So the people that already know me from before, right, they are here, they know how I am even in person. I'll stay longer, I'll stay here with you guys answering questions. It's a different impact, totally different, right? All right, iCarly, so meeting people for mortgage is the buyer's monkey, not the agent's. What do you mean? For the people to sit down with the loan officers, if that's not your monkey? Well, look, I don't know what kind of realtor you're going to be, and I'm not saying anything wrong, but I like the way you put the question. I don't know what kind of realtor you're going to be. What I know is how I set up things. The way I set up things is, for instance, let's say I have a client for Edith, or Edith has a client for me. I'm going to set an appointment so the three of us, me, Edith, and the client, sit down together, right? You have to have a close relationship with a loan officer, because not only do you depend on a loan officer depends on you, because they're going to give you the information for what type of house they qualify for. It's not only the amount, there's the taxes, the down payment, and you have to coach your clients to be ready for that, and vice versa. You want to make sure that the loan officer understands what you're looking for, and the client doesn't always know how to express it. You want to make sure there's no miscommunication. You have to have your team of players. The loan officer, the title company, the attorneys, the inspectors, you understand? And you're the one leading the whole orchestra. You're the one That's the maestro. You're the one organizing everybody from beginning to end, right? So Carly, we don't just refer. You keep close contact with, hey, this is the loan officer I would recommend you speak to. By the way, let's set up a conference, sit the three of us down, and go over the details as much as you can. If you can't, if it's impossible, Carly, then what you're going to do is set up a meeting right after with the loan officer and make sure, hey, Edith, in this case, right? Edith, hey, this is the scenario I was looking for. I'm not sure if the buyer told you this, but this is the scenario. What do you think they're approved for? And vice versa. Now we're going to start a conversation that I can then relate to my clients instead of, oh, but the loan officer told me, or oh, but the realtor told me. You don't want the he said, she said type of thing. So we don't just refer, we make sure everybody's on track towards the common goal because we have a client in common. All right. If I had no dealings with a transaction, I'll be like, hey, here's a client I just referred, and I'm out. I'm not representing on the buyer side, on the seller side. I'm not representing anything. I'm not even making money out of it. I just referred. You understand? If I have no dealings with it, no problem. But if I am part of the transaction, I'll try to be in it as much as possible. Don't let anybody talk without you being involved. Because again, you coordinate everything. You're the one looking for the house. You're the one that's requesting the paperwork. You're the one that's making sure that the client complies with everything. Otherwise, if you depend, no offense, Edith, no offense to anybody, but if you depend on attorneys, loan officers, title companies, and so on, nothing gets done. You need to be able to follow up. And you will not know how to follow up if you don't have the information. Okay? Gloria, if a family member is a loan officer and refers to you vice versa, is there anything against that? Gloria, as long as there's no money involved, or if you are a loan officer yourself, there might be money involved. If they are a realtor, then there might be money involved. But they have to be licensed in that trade in order to be receiving money or giving money. If there's no money involved, they can refer to you all day long. Just remember one thing. Your client must be aware of everything. You don't just refer knowing that you have an interest. You have to tell your client, hey, look, if you don't have anybody, I can recommend this person. You cannot force anything. By the way, this person is a family member as well. So you have to disclose anything that could be a potential conflict of interest. You have to. It says their fees are crazy. Whose fees? Wait, I lost you on that one. Whose fees? Katya says team up is best. Yep, team. Oh, lending tree. Oh, yeah. Lending trees. Yep. Anyway, only because they shop everybody else and they service the transaction. So they charge you application fees and whatever, whatnot. Ridiculous. All right, back to this. We got 1 hour. So, secondary market. What is secondary market? It's where loans are bought and sold after being originated. So think about this. I'm the manufacturer. I created this phone right here. I'm the manufacturer. I created the phone. Okay, I'm going to put it on the market. I'm going to sell to you. Right? The first sale or the first action on the market is where primary market, where loans are originated. Now, is there anything that stops you from selling this phone to somebody else? Nothing stops you. There's always somebody that wants to buy, somebody wants to sell. That's a secondary market. After the original, it becomes secondary. So there are people that will buy loans. This is called buying the note or investing on the note, because the note is the loan, right? So there's people or entities that do this. Some of the common entities that buy loans already originated, okay? Some of the common entities on the secondary market are Fannie Mae, Freddie Mac, Ginnie Mae, investment firms that assemble loans. So we can be an investment firm. We put all our money together to buy loans, right? Life insurance companies, pension funds, or primary market institutions who also invest as secondary lenders, okay? So these are the players in the secondary market. Do they lend? No. They buy on the secondary market and they sell on the secondary market. So if they ask you in the state exam, all of these are secondary market players, like they won't put players, but they operate on the secondary market, except who does not operate in secondary market, right? Well, these ones usually do not operate in the secondary market, okay? Who operates in the secondary market? Most likely they'll have something like Fannie Mae or Freddie Mac. Most likely, okay? These operate in the secondary market. So how does that work? All right, hold on. Antar said, but life insurances are listed in both. Okay, so usually, which ones are the most common to be in the primary or secondary market? Life insurance companies, yes. Life insurance, any insurance company, they can operate in both. Why? Because they want to secure their investments. The way it works is very simple. You guys pay premiums, but there's always the chance of an accident. There's always a chance of that accident not being a $300 accident. It's going to be a $3 million accident. There's always a chance of you putting a $1 million policy for 30 years, but you die 5 years later. So they have to pay before they received enough money, right? So there's always that the option of that happening, right? So to protect themselves and their investments, what do? They lend money to make more money, or they buy loans in the secondary market as well. So yes, insurance companies are in both. Investors, direct lenders are in both, right? But if you notice, the most common ones, that's where we're talking about commercial lenders, bankers, mortgage bankers, they're in the primary market, they're not listed in the secondary. So you have to look at which ones are the most common, not the ones that are in one and the other. Look at the ones that are most common in one field versus the other. That's how the question is going to be, more or less. Now, if you look at it, you are the borrower. Where does the money come from? From the primary lenders. How do primary lenders get their money? From the secondary market. Who's in the secondary market? Investors. So investors will buy loans from the primary lenders so the lenders can lend more money. That's what we're saying here. Why would they make more money? Why would they make more money or need more money? Well, if you're in an area like Newark, as an example, here where I am, there's a lot of purchases. So there's a lot of need for money. If you're in an area of the country, right, where there's like, hey, people have been living here for 20 years, 30 years, then loans are not as necessary. Here in Newark, as an example, in Harrison, Jersey City, New York, right, there's a high turnover. Like people buy today, sell tomorrow. So when I say that, it's like in an average of 7 years. That's what it used to be, an average of 5 years, but now it's every 7 years somebody moves, right? Life changes. So because that happens, there's a high demand for money. In one day, in this area, in one day there could be 100 loans originated in this area, like in the whole Essex area, right? There could be Essex Hudson area. There could be 100 loans originated or more. Do banks have that money available, readily available? No. In fact, I challenge all of you, go tomorrow to your bank in the morning and say you want to withdraw the whole 35 cents you have there. It's a joke. The joke is very simple. I don't know if you guys remember when the market crashed, there was something called Occupy Bank of America. So there was Occupy Wall Street and then Occupy Bank of America. Everybody got so upset with the way Bank of America was operating, right? The whole scam about foreclosures and everything. And they were still giving money. They were charging you fees. They were foreclosing on you, and they still gave bonuses to their managers and investors and whatever, right? So people went to all banks of America and started asking to withdraw the money, to the point where Bank of America had to have police at the door and stop you from coming in, because they don't host the money at your bank. They keep, if you guys remember, they keep a reserve. For every $100 million, they get like 5% in the account. So each bank might only have 5%. So if everybody goes there and asks for their money, even if it's 35 cents, they might not have it. They have to draft the money from one account to another in order to, like, because they have their general account, one account to another to make the numbers available. That's the internal accounts. You guys understand? Your money, every money you deposit there is lent out. You guys ever read that when you applied for your checking account? It's written right there that they can use your money. You guys read that? That you deposit money and they lend your money? And if you apply for a credit card with them, they lend it back to you. Or a loan, they lend it back to you at 6% or higher. You give it to them at $0, they give it back to you at 6% or more. Right? They only have to keep 5%. Anyway. So that's how it is. They don't have the money. So they have to sell money, get paid, so they can lend more money to you. Now, the major players in the secondary market are Fannie Mae, Ginnie Mae, and Freddie Mac. Okay? So why are they the major players? Because they're the largest purchasers of notes. So Fannie Mae, I call Fannie Mae Grandma. She's the oldest one on the block. Grandma controls everything. In fact, Grandma purchases 1 out of every 10 loans that are originated. It might not sound like much when there's thousands of players on the secondary market and Grandma gets 1 out of every 10. Yes, Grandma's the one with the biggest power. They're a privately owned corporation, privately owned, and they buy conventional FHA and VA-backed loans. Okay. They give banks mortgage-backed securities in exchange for blocks of mortgages. They offer lenders firm purchase commitments provided that they conform to Fannie Mae's lending standards. They sell bonds and mortgage-backed securities, or they guarantee payment of interest and principal on mortgage-backed securities. So let's talk about Fannie Mae real quick. What does Fannie Mae do? They buy loans. They don't originate, they buy. This is something you have to remember. There might be a question in the school or state exam. What does Fannie Mae do? They buy loans. Okay? They don't lend, they buy. Okay? They don't originate, they buy. That's the key word. Buy loans. Okay? Now, they also offer firm commitments to lenders. In fact, guys, the banks regulate by Fannie Mae's guidelines. As you see here, they'll say, Fannie Mae says, I'll buy your loan if it conforms to my guidelines, my investment guidelines. All right? And this concept is very simple. If you want to remember Fannie Mae and how powerful they are, imagine, guys, that I am your investor. What does that mean, your investor? It means that, look, I'll buy any house that you see out there. I'm serious. Any house. There's only one requirement. That the houses are green. That's the only requirement. The house must be green and I'll buy any house. I got that much money. I just care about one thing, is the house being green. So I'm Fannie Mae. I just care about the house being green. That's my guideline. How many houses would you bring me for me to buy if I was your investor? Chrissy, I just saw your message. Your Wi-Fi is being weird. Optimum? If it's Optimum, sucks. If it's Fios, Way better. Anything else, it's worthless. Fannie Mae's Italian. Definitely. They control the market. They're the mob. So guys, you still did not answer my question. How many properties would you bring me? I'm your investor. You're a realtor. Think about yourself as a realtor. I'm the guy that will buy any house you bring me. I'm your preferred buyer. How many houses would you bring me? As many greenhouses. What does that mean, as many greenhouses? Carly says a lot. Katya says it's kind of difficult because there's not many greenhouses out there, but as many as possible. Joanna says all the greenhouses. Stacy says all of them. You guys are missing one thing. Paola for the win. Stop right there. Stop everything. You don't have to text anymore. Boom. So from 2001 mainly till 2008, this is what was happening. Banks were painting the houses green, right? Now, we're talking about loans. They knew that Fannie Mae, Freddie Mac would buy everything and anything. So they're buying packages. They don't even look at the numbers. They trust the banks so much at this point, they're buying anything. So the lenders, the banks, were sliding in between those 100 good notes. They were slide one or two, there were bad ones. They just painted as, oh, this is the one you wanted, right? Slide it right there. So they were certifying them as good loans, right? The problem is a lot of these loans that were issued back then were loans to be faulty loans, right? If you guys remember, I talked about ninja loans. No income, job, or assets. You didn't have to prove anything other than, all right, I got a pulse. I'm breathing, right? You can feel I'm not a ghost. Not me. I'm talking about the borrowers, right? So they could verify that somebody was real. We did not need to know your assets. We don't care if you make money or not. We'll state it. We'll make it like you make $12,000, hairdresser. Remember that story, right? That's how they were planting and giving it to Fannie Mae. They were painting them green. Why? Because again, Fannie Mae's guidelines were, as long as it matches my guidelines, I'll buy everything. So if Fannie Mae said, credit score, 620 is the minimum. If Fannie Mae said up to $300,000 house. If Fannie Mae said income must be at least $50,000, let's say, something like that. If that was Fannie Mae's guidelines, you would get a loan. If you did not qualify with Fannie Mae's guidelines, they were painted as if you would. And Fannie Mae would buy. So that's why all the loans that conform to Fannie Mae's guidelines or to Freddie Mac guidelines are called conforming loans. Everything that goes above Fannie Mae's guidelines are called jumbo loans. You remember I had a question about jumbo loans? I forgot who asked me that question. But there was a question about, well, what about jumbo loans? Well, it's anything and everything that doesn't go according to Fannie Mae. So it's the yellow houses versus the green houses, right? Very, very important you guys remember. Fannie Mae and Freddie Mac determine the type of loan that you get because they're the biggest players, right? They determine the type of loan you get. Lenders change their guidelines to meet Fannie Mae's guidelines. Then we have Ginnie Mae. Now, Ginnie Mae is the baby, the newest kid on the block, and the reason why Ginnie Mae is here is to help you, because of what happened before, with high-risk, low-yield mortgages and absorbs the difference in yield between mortgages and market rates. Ruth says it sounds like a baby, yeah. So Ginnie Mae is the baby because they came after the whole thing happened. Crash. They're like, whoa, wait, we can't let the hot potato can't drop. That was Freddie Mac and Fannie Mae as they were failing, right? They were failing. They were going bankrupt. And the government says, no, we have to bail them out and we have to create something that supports them. Well, Ginnie Mae came along. And who's Freddie Mac? Well, Mac Daddy has been around too. But Mac Daddy's more for for conventional loans and savings and loans association loans. They don't get involved with FHA or any other government-backed loan. They're more for the conventional loan. All right, so they buy mortgages also in the secondary market. Okay. Any questions? Let me know if you have questions before I move forward. All right, so you have to remember Fannie Mae, Ginnie Mae, Freddie Mac. In the state exam, if they ask you about like all of these work in the secondary market except, well, Fannie Mae, Ginnie Mae, and Freddie Mac, they're all in the secondary market. The fourth option is going to be the exception. Guaranteed or your money back. Okay, if there's a question about who operates in the secondary market, and you see Fannie Mae, Freddie Mac, Ginnie Mae, that's what it is. Those three operate. So the fourth one is the one that doesn't. All right, Carly. So Freddie and Fannie don't go hand in hand. Well, Fannie and Freddie Mac, they're the largest purchasers. Fannie Mae being the largest one, Freddie Mac being the second one. But because there's more FHA loans than anything else, Fannie Mae is also the largest purchaser, right? The concept is the same. They both buy loans. They don't originate loans. The concept is the same. So they go hand in hand in terms of anything that's conforming loan is either a Fannie Mae or Freddie Mac, because again, they're the two largest purchasers in the secondary market. That's the only thing I can tell you there. Okay. Traditionally, no. Traditionally, they focus in conventional loans. So they do buy a few. Okay. Doesn't list much here. They do buy a few, but not that many. They're mainly focused. So they buy mortgages and pulls them, selling bonds backed by mortgage in the open market. But they, it's like Bonnie and Clyde. There you go. In there, yep. But what they do is they buy more the conventional loans or savings and loans associations loans, right? It's definitely Bonnie and Clyde. They rob you blind, right there and then. If they fail, then the government's back to save them. That's all it is, because they want the story to keep going. Carly, would they be referred as these nicknames? So yes, Fannie Mae will. Freddie Mac maybe. Ginnie Mae, you'll just see either GNMA or it will have the full name, which you guys can see right here, Government National Mortgage Association. But that's why I have them highlighted: Freddie Mac, Ginnie Mae, and Fannie Mae. The only reason why it's called Fannie Mae is FNMA, right? So FNMA, so Fannie Mae. Ginnie Mae is also easy. GNMA. I don't know what happened to Freddie. I don't know how we go from FHLMC to Freddie Mac. Anyway, since we got Fannie, we had to have Freddie. That's what it is. All right. So now I'm not sure about your question. You said Ginnie Mae works same. I'm not sure what you mentioned there. All right, so types of real estate loans. Here's what we have. We have conventional loans. We have FHA insured loans. We have VA guaranteed loans. Those are the most common. Okay. Then we have different loan structures, which we're briefly going to talk. We have seller financing and special purpose loans. So conventional loans, what you need to remember is that these are not FHA insured or VA guaranteed. So therefore, they are between lender and borrower directly. Okay. Now, the other loans are also between lender and the borrower directly, but with government influence. This one is without government influence, as we just said right here. So without government, oh, missing something here. Influence. Okay. So again, guys, here's what we have. Conventional loans is you go to Bank of America as an example and say, hey, Bank of America, I want a loan. Bank of America looks at you and says, well, you're stable enough. I'm going to lend it to you directly. Okay. If you're unstable or unstable, right, meaning your credit score is a little low, your income is not that high, right, or you don't have enough down payments, then maybe we're going to fit you into an FHA or a VA guaranteed loan. What's the difference? Well, government gets involved. Okay. Now, FHA does not lend money. So we're not saying government gets involved like they're going to lend you money. No. But they will insure the lender. They will insure the lender. What does that mean? Well, it means that if you don't pay, if you go through foreclosure, FHA has, do you guys remember MIP, mortgage insurance premium? Conventional loans have PMI. FHA has MIP, right? If you don't pay and it goes through foreclosure, MIP is an insurance that you've been paying that if you default, the lender is able to recover. It's like gap insurance. The lender is able to recover 20 to 25% of whatever the loss is. So if it goes through foreclosure and there's not enough money to cover the loss, they activate the insurance from the government to pay them, pay the lender. Okay? It's never to protect you, it's to protect the lender. Okay? That's mortgage insurance premium, MIP. It's different than PMI. The process is the same. The intention is the same, but different names. PMI is for conventional only. MIP is for FHA. Now, have you guys ever heard of this? FHA 203B? Anybody? Let me know if you have. Give me a number 1 on the chat if you have. Give me a number 2 if you haven't. And I'll bet everybody heard of it already. All right, those of you saying no. FHA's 203B is the most common loan, and it's called First Time Home Buyers Program. So have you ever heard of FHA, First Time Home Buyers Program? All right. That's what it is. It's the most commonly used program, the FHA 203B. B for buyers. Come on, that's easy. Because we also have K for construction. Easy, K, construction. How we spell things, right? It couldn't be 203C, it has to be 203K, right? All it means when you have a 203B or 203K or any other of those alphabets, letters, right? It means that it's a program under Title II, which is from the Federal Housing Administration, Title II, Section 203, which refers to loans. Loans under the Federal Housing Administration. So we have the 203B is the most common. The second most common is the 203K for construction. Now the 203B, or First Time Home Buyers Program, as it's usually called, allows you to buy a 1 to 4 family residential property with little to no money down, right? I'm going to explain that better in a second. Tatiana's like, now it's easy, right? Just got to know the alphabet. B for buyers, K for construction, easy. K is like that Cars for Kids, right? You've heard that Cars for Kids ad, right? K for cars, Cars for Kids. Who has the jingle in their mind right now? Raise your hand. Sucks, doesn't it? Yeah, Bruno, why did you do that? I hate you right now. Yep, I know. It's one of those jingles that you can't get rid of. By the way, I do this in every class. I love messing with you guys. All right. Now, one of the things that I like about FHA programs is the low down payment. So Wafa just wrote 3.5% down payment for first-time home buyer. It's the low down payment, so you don't have to put a lot, right? So it means higher LTV, right? Because the down payment and LTV, they're interchangeable based on value. The thing is, we must determine value. That's the thing I don't like about FHA programs, which is they send their own appraisal. You cannot choose your appraiser. They send their own. And this appraisal, again, must be an FHA-approved appraiser. If the property does not appraise, you have a couple options. Either you come up with a difference, so you pay more, or you walk away. And that's the highest risk when dealing with FHA buyers. And the risk is you. Because you, I'll tell you right now, you are the one that's going to tell the buyer, hey, it's listed for $400,000. You're looking for a house with up to $400,000, so perfect house. But you never looked at the value of that house that you're bringing your client to. Just because it's listed doesn't mean it's the right price. Because a lot of realtors fall into the seller's demand syndrome. Okay? Oh, if the seller said, then I'm going to do it. Right? Big mistake. All right? A listing agent needs to know how to put his or her foot down and tell the seller, your property is not worth $400,000. Your property is worth $350,000. Your property is worth $300,000. Why is this important? Because if we bring an FHA buyer, there's a maximum loan amount, and the loan amount is based on appraisal. Okay? So the maximum loan amount is restricted to the LTV ratios, loan to value. So if the property does not appraise, Mr. Seller or Mrs. Seller, if the property does not appraise, the buyer has the right to walk away. Do you really want to waste your time? Do you really want to waste my time? Let's make sure your property is worth or listed for what it's worth, right? Simple. Otherwise, it's going to stay on the market for too long, or if you do get somebody that's interested, it might not appraise and the deal falls through. You wasted time, I wasted time, nobody wins. The buyer wasted time, right? So if you have a buyer, regardless of being FHA, conventional, or anything else, look at what it's listed for. Look at the house and be like, oh, no, it's not worth it. Right? You're going to go to the house with the client, so might as well see it. I just saw a property on Saturday. I'm looking at it and like, how is this worth $440,000? Right? The rooms were tiny, right, compared to other properties in the area, because you have to go by market. The rooms were tiny, right? It didn't have a garage compared to the other ones that we've seen that were around the same price range, right? How are they asking for $440,000? It's impossible, right? The pictures, by the way, the pictures are amazing. On the MLS listing, those rooms were big, right? The wide lens worked perfectly. Deceived the client, deceived me. And here we are showing a property where you got to walk in like that, right? But on the picture, right, the hallway was huge, right? I could put furniture in the hallway based on the pictures, right? So guys, it's your job. It's your job to also look at that, right? Also because you don't want to waste your time. Simple. If it does not appraise, people will most likely walk away. There's not many people that will say, no, Bruno, I really, really want this house, so here's an extra 20. Here's an extra 30. I got it, no problem, right? I love overpriced stuff. Not many people will do that. Wafa says, you're right, it always happens. I know. Wafa, conventional loan, we choose the appraisal? No, it's just that the appraisal is a little different. For a conventional lender than an appraisal for FHA. It has to be FHA certified, so that means the appraisal has to follow their guidelines. They're stricter. That's all it is. All right, down payment requirements. Currently, the requirement is 3.5% down payment. Guys, real quick, just because it's 3.5% does not mean But that's all the money you need. You don't look into your pocket and go like, I got $3,500. I can buy a $100,000 house. That's not how it works. Not how it works. You still need closing costs. All right. Now, sometimes we can negotiate with the seller to cover some or all of the closing costs up to a certain amount, but the buyer must be ready for that. You must tell your buyer, great, you got the down payment down packed. Great. So maybe we need a gift for the rest. Remember the gift letter? Maybe we need a gift for the rest. Maybe we can get the seller, not guaranteeing because it's a seller's market, and right now, if you don't have the money, somebody else does. So you might lose the deal because of that. But maybe the seller will contribute towards the closing costs, right? So remember, 3.5% is the down payment requirement, but there's other costs involved. Can we buy the house ourselves? Why not? You can even use your part of the commission, your side of the commission, as a credit towards the down payment. So you can represent yourself in the purchase. Yep, and use your commission. Tati says, I see the Benjamins. Listen, it was all dollar bills. Don't be fooled. I put zeros next to it. Right? You always got to impress. That's how it is. All right, prepayment. Something to remember. Federal-backed loans have no prepayment penalty. So if you want to pay off, let's say you win the Mega Millions or the Powerball. Tomorrow is the Mega, right? And then Wednesday is the Powerball, something like that. If you win the Mega or the Powerball and you decide, well, I just got into a loan, 2 weeks later when you receive your money, you want to pay off the whole loan? If it's an FHA or a VA loan, government-backed loan, there's no prepayment penalty at all. Okay, this is the national side of it. In New Jersey, we'll talk about it in a different chapter. In New Jersey, for instance, and some other states, it does not matter if it's federal or conventional loans, there's no prepayment penalty for mortgages. Some states allow prepayment penalty, but never for government-backed loans. Stacy, I'm sorry. If I did, oh, I just got it right now. I didn't read it properly. Stacy's like, if I did that, moths would come out. This is what I'm trying to tell you. That's why they're all ones, right? They're all ones. You just put zeros next to it, and nobody will be able to know. I mean, how would they know? Right? TikTok, anyone? How would they know? Fine. I love TikTok, by the way. You learn a lot of stuff besides the thing. Jaquana, they're gonna know. There you go. $100 bills are greener, brighter. See, I don't have them. There you go. Yanira says, no one will know. Can you put a wig and take the test for me? Listen, I've been offered that already, and they will know. They will know. Only because I won't shave. Sorry. You can't pay me enough to shave. Only my daughter has the power to do that. My 11-year-old daughter asked me to shave the other day, and I did it. She's the only one. Nobody else. So if you want me to shave and put a wig, you got to ask my daughter. Simple. All right, the next one is the Veterans Administration or VA loans. Now, the VA does not lend, they guarantee loans. They do not lend, just like FHA. They guarantee loans. What do they guarantee? They guarantee the lender, again, that if you default, if you stop paying, the VA will cover whatever the loss is. Okay? Now, the cool thing about VA loans is this. VA requires no down payment. So if you're dealing with a veteran and they want to get a loan Their VA loan requires no down payment. That means you can buy a house with no money down. It says here, although the lender may require one. What they require, usually it's called a funding fee. And it's like a ridiculous 0.5% or 1% instead of 3%, 5 or 20, right? So a ridiculous funding fee. Depending on how many times you use the VA loan, you become riskier. So the bank might charge you a higher funding fee. The other thing they have is this. For the appraisal, they have what's called a certificate of reasonable value. I call this the Honda. Why Honda? Because it's a CRV. Believe it or not, I had a student that texted me after the state exam, texted me, this is like 4 years ago, texted me, says, Bruno, I remember the Honda. And it was funny because I was talking to her about a month ago, and I went to see the message. I just wanted to laugh again. So I went to see the message. It literally, instead of telling me, Bruno, I passed, no, Bruno, I remember the Honda. Like all excited. I'm in the middle of a class. I see the message come through as I see your messages here, right? And I'm like, I cannot even laugh at that. I can't even stop right now because we're on time constraint already. But during the break, I see it. I'm cracking up. I send her a message and I go like, okay, that's great. By the way, did you pass? Like, that's all I wanted to know. I'm glad you remember the Honda or the jokes or whatever, but did you pass? And she's like, oh, yeah, I did. Like, it was more important to tell me about the Honda. Guys, stuff we remember. Appraisal for VAs, it's called a CRV, Certificate of Reasonable Value. All right, Wafa, there's a question. If I put an offer for the house, they accept it, and I get credit to fix some stuff, what is the best we could use the credits using for closing? What's your... Well, if the credit is to fix some stuff, then it's to fix some stuff. It's not towards closing. That's what it is. Okay? There's a closing cost and there's a credit towards fixing stuff. How would the HIP insurance work with that for... You're talking about PMI or MIP? You wrote PIP, so I don't know if we're in the personal injury protection. This is not property and casualty, my friend. You're typing more. Okay, Gloria, do you have to have a certain amount of active duty time? Yes. So for you to qualify for a VA loan, you have to have 90 days of active service during wartime, or 181 days during peacetime, or 6 years as in the National Guard or federal or in the reserves, right? So it's either 90 days of active service, active duty during wartime, 181 days during peacetime, or 6 years the reserves or National Guard. Okay. Speaking of which, for you to figure out if you're qualified, you must obtain what's called a certificate of eligibility. So you cannot just say, oh, I'm a veteran. Can you get me a loan? No, you have to get the VA to issue a certificate. Chrissy, I'm glad you're paying attention. Are you sending me a voice message? Is that what it is? Terrible. We can change the price of how... I'm lost in your question. We can change the price of how with this credit? What do you mean? The price of the house? No. You don't change the price of the house, no. If it's at closing, a credit at closing to fix something, it doesn't change the price of the house. You just get a credit. You get a check for whatever you're whatever you intend to do. Tracy's like, these are my talk to text notes. Yeah, sure. Antar, PMI, would that still apply for a VA with no down payment? So no, they don't have that insurance. They have, like I said, a funding fee. That's what it is. All right. Yes. So yeah, the discharge paper, honorably discharged, because they have to give you a certificate of eligibility that says you're honorably discharged. Yep. All right. If VA has no down payment requirements, they still have to provide all docs to get approved. Yes. So it's the same thing as FHA, the same thing as conventional. You have to prove that you are qualified. Yep. Chrissy, is the exam on the computer or written? No, it's a voice to text. Wafa, have credit from inspection. Okay, so that will be a credit that you'll get at closing. You can talk to your attorney and see if you can, and the title company, see if you can apply that towards the down payment, but usually no. Tati, I don't understand. You said what, and then Bruno? I don't know what you're asking. Oh no, it's just like her notes. It's the voice to text notes that she's doing over there. That's how the exam is going to be. It's on the computer, and it's multiple multiple choice on the computer. Yes. Or in writing with your right hand. No? All right, real quick. We only have a few minutes left. I know you can't do it, that's why. Amortizing loan. What is an amortizing loan? First of all, let's look at the word amortizing. What does that mean? Mort. Nobody? Mort. Very good. Death. So amortizing, because of mortgage, right, is the death of the loan. So until the loan dies, you're paying. And as you pay, it's slowly killing the loan. That's what it is. Amortizing is slowly killing the loan as you make payments. Now, just for, just to mess around a little bit. Did you see this? Yep, Stacy. Love and death, one letter away. Crazy, right? Don't people say I love you to death? That's what it is. I amortize you. That's your new word from now on. When you go home, talk to your significant. Well, you're home. When you talk to your significant other, hey, I amortize you. Right? I'll kill you slowly until you die. That's what it is. Until this love is over. Anyway, I have too much fun. Antar, regarding the state exam, will you let you know if you got the answer right or wrong upon submitting? So Antar, in the state exam, they'll tell you either pass or fail. If you fail, they'll give you the classifications of, the categories where you failed, but they don't give you the right or wrong answers. Just the categories, that's it. If you pass, it just says, congratulations, you passed. It doesn't tell you by how much. I'll know because I get the report, but that's it. All right. Katya says, can I start now? You can start amortizing Amberson. That's up to you. Start killing him. That's it. Just don't tell him that I said it, okay? I'll text him myself to say I'll give you permission. All right. So amortizing is pretty much, if you have a fully amortizing, that means the principal balance is zero at the end of the term. All right. So what does this mean? You guys see right here, the figure that I had before, you borrowed for 30 years, right? Let me clear this out. You borrowed $300,000 for 30 years. At the end of 30 years, you've been paying $1,000 every month. Your final payment right here is $1,000. And this $1,000 brings the balance to zero, right? Started at 300, it ends at zero. So after 30 years, balance is zero. This is called amortizing. So as you pay, the principal balance goes down, right? It's called amortizing. If it's a fully amortized loan, your first payment, $1,000, is the same as the last payment, $1,000. If it's a partially amortized payment, right, it's a little different. If it's a partially amortized payment, that means the payments are not sufficient to retire the debt. So at the end of the loan term, there's still a principal balance to be paid off. These are called balloon payments or balloon payments. There's still money to be paid because we're not paying it off fully. So your last payment is going to be, instead of $1,000, your last payment is going to be $5,000 or $50,000 or $100,000. All it means is that you did not put enough to amortize. Okay? You're not killing it properly. That's what it is. Okay? The next one is negative amortization. Doesn't matter how much you're killing it, like you're paying, you're trying to kill it, right? Doesn't matter how much you're killing it, the balance is increasing. Instead of decreasing, because you're amortizing, right? Douglas, are you with us? Instead of decreasing, the balance is actually increasing. So at the end, you owe, let's say, $15,000 more because you did not pay amortize. Okay? When does this happen? When you have an adjustable rate mortgage, if you don't put enough, not even to cover interest, then the loan is not sufficient to amortize anything, right? It's less than interest only. And that difference, they add on to the principal. Okay? And that's what happens. That's what happens usually in adjustable and fixed rate loans. Okay? That's what happened in 2012, 2007. That's the first set of adjustable rate mortgages that reset, and people owed more than what the property was worth. So a lot of people back then, they stopped paying. When the market crashed and they look at their balance and like, oh, I owe more than what it's worth. Let me stop paying. 2012 was the largest boom of all these adjustable rate mortgages. Everybody was negative. Not only because market crashed, but also because they were paying, and there was not enough. So they borrowed $600,000, they owe $700,000. And the property is now worth $300,000. Right? So you got to a point you're like, why am I paying this? Right? So that's what it was, adjustable rate mortgages. What is the difference between adjustable and fixed rate? Adjustable is variable. Fixed is fixed. So adjustable is a mortgage interest rate that fluctuates. So you start off just like the stock market. You start off with 5% interest rate, and 6 months from now or a year from now, you're at 8% interest rate. And then a year later, you're at 2% interest rate. So it keeps on fluctuating. It's never fixed. A fixed rate is you start off with 5%, you end with 5%. The rate is constant. That's the difference between them. All right? Any questions there? Ingrid's like, is this like a reverse mortgage? No. So reverse mortgages, they're annuities. I'll explain that better later. But in a reverse mortgage, they're paying you instead of you paying them. I'm talking about you paying, and they still, your balance still increases versus decreasing. All right, interest only, as the name says, it's interest only and not to principal. So at the end, you have a balloon payment. So very simple. I borrowed $100,000 interest only. I pay for 10 years. At the end of 10 years, how much do I owe? Real quick, this one should be easy. it's interest only. I borrowed $100,000 interest only for 10 years. At the end of 10 years, how much money do I owe? Anybody? Don't all answer at the same time, just one. Carly for the win, $100,000. I owe exactly what I borrowed because it's interest only. So no payment is going to the principal. At the end, I owe the full principal in a balloon payment. Yes. Some of these things are simple. I'm just going to go right through. Purchase money mortgage. The name already says it all. You have no money to purchase. What kind of mortgage do you get? A mortgage that gives you the purchase money. So every time you see purchase money mortgage, it's money that's given to you for the purchase. Now, it could be from a lender, like a bank, or it could be from the seller that helps you buy their property. So let's say you want to buy my property, right? You want to buy my property, then me as a seller, I become the bank. I lend to you. How do I lend to you? By creating the credit. I don't have to give you money to buy my house, but I give you the credit. I tell you, okay, you don't have the money? Just give me 20% down payment, right? Give me 20% down payment. And the rest, the 80%, just give me the installments for 30 years at 10%, as an example, right? So I become the bank. You become the borrower. You're buying my house and you become the borrower. That's what it is, okay? So instead of the going to the bank, the seller becomes the bank. Okay? It's not the same as rent with option to buy, because a rent to option to buy, you're renting. So it's a lease. At the end of it, you can exercise the option. So at the end of it, you can say, yeah, I want to buy. Seller, would you consider financing the purchase for me? So now it becomes, if you want, a purchase money mortgage. During the renting period, you're just renting. When you decide to buy, then it's different. Guys, make sure you have no distractions, please. This is going to become way more difficult as we go. If you keep on getting distracted, I can't guarantee your success. Okay? See? Smack you and then I smile. But it is. I'm going to skip wraparound mortgage for now. I want to go to contract for deeds, only because of time constraints. By the way, wraparound mortgage, guys, go to my YouTube channel, okay, and search wraparound mortgage. I have an in-depth explanation there of what it is. Okay, it's not as heavily tested as it used to be, but go there and check it out. Contract for deed, I already told you guys before what this was. It's also considered an installment. Sales contract. We talked about that under contracts. And this is similar to car financing. Why? Because you get the deed at the end, just like your car. You only get the title once you finish paying it off, right? So you get the deed at the end. Contract, already says contract for deed. So I'm going to pay you in installments, but I'm not the owner until I finish paying it off. Okay? Next, we have special purpose loans. Under these, we have home equity loans. Okay? What does the word equity mean? Does anybody know what equity means? Value. Okay. So for you to have equity in a property, that means you have value in the property. How do we determine value? How do we determine value? Well, very simple. So market value, that's the sellable value, right? Market value minus loan balance equals equity. So the more you pay off your loan, the more equity you have. As long as the property value keeps on increasing and your loan balance keeps on decreasing, your equity increases. That's the difference. So a home equity loan, it's based on this difference. How much equity do you have? Can you tap into it? So if you have $100,000 equity, you can get $100,000 or a percentage of it, depending on the lender, equity loan. Okay. I'm not a big fan of home equity loans. I prefer home equity lines of credit. So these are HELOCs. Only because a HELOC is like a credit card. So you're using your property. So this is under home equity loans, right? You're using your property as security for a credit card of $100,000. Okay? If you only need $10,000, you use $10,000, you pay it back. In a home equity loan, if you borrow $100,000, you have to pay back $100,000. So I prefer to have the credit card of $100,000 and use what I need versus paying interest on the whole thing. You guys understand? So even if it's a higher interest to use $10,000, it's still better than a little bit lower interest and borrow $100,000, right? And I can rinse and repeat. So I use HELOCs, for instance, to buy material for construction of another house, or even to write a check just to buy another property at the sheriff's sale. So you buy properties, fix the properties, pay back your loan. Simple. Refi and pay back your loan. How you do it. All right. We're already done, but it's real quick. Package loan is easy. There's a package deal. That means you're buying real and personal property. Real and personal property. That's what it is. You don't have to say that. You can always. If you have a promotion, let us know. Give us the info. Construction loan, that's easy. You guys already know that it's for construction. What you need to remember is that the loan is usually interest only, just like hard money loans. And the borrower makes periodic payments based on the money that's been dispersed. It's a short-term, high-risk financing, and interest rates are higher. Okay? Construction loans, these are not permanent loans. If it's a construction loan, it's not permanent loan. What does that mean? It means that you need to convert your construction loan to a permanent loan. Now, it's either the lender allows you to convert, or you need to have a takeout financing. Takeout financing means you're getting the money elsewhere, another lender. So one for the construction and one for the permanent loan. Okay? Antar, what's the difference between construction versus 203K? No difference. It's just there's conventional construction, there's FHA construction loans, there's VA construction loans. We're just talking about construction loans in general. The FHA usually has a provision that will convert to a permanent loan, while conventional, usually they tell you, here's a financing for the construction. Whenever you're done, kick us out. So get another loan. That's what it is. All right. Bridge loan. A bridge covers a gap, and this gap is a financing between short-term construction financing and long-term permanent financing. So if you find yourselves at a point where you completed the construction, but you still were not able to get another loan, then you get these in-between loans. That's an example, right? So these in-between loans are very expensive. They're interest only and usually short-term, so it's like a 6-month loan. Participation loans is where the lender participates in income. So if you ever see participation loan, that means the lender becomes your partner, kind of. They now have equity. So when you sell the property, you owe them money on that appreciation. So it's lending plus appreciation. And I know I'm going fast. There's a lot of stuff here that's not even not regularly tested. So it's highlighted. It's easier to read. Just go right through. All right, Ingrid, you asked me about reverse mortgage. That's what this is. Reverse annuity. What is an annuity? It's a retirement program that pays you every single month. So instead of you paying the bank pays you. Who'd like this type of loan? Where the bank pays you? Wrong. See, the thing is, with a reverse mortgage, you lose the property. It says here you don't lose the property, but you do at the end. It says here you don't lose the property, but you do at the end. So what the annuity does is helps you if you're a senior. These are usually for seniors. You can tap into the equity that you build up over time, right, by paying it off. You can tap into the equity. Why would you do that? Well, I don't know if you guys ever seen somebody on Social Security, like you're retired and here's your Social Security, right? It's 40% of whatever you used to make. So if you made $2,000, 40% is how much? Not enough, right? Can you survive on 40% of $2,000? No, of course not. So you're going to tap into your equity, and you force the bank pays you, right? The bank pays you, and at the end of it, you don't lose possession, but at the end of it, you lose your property because the bank takes over. It's either you move out and sell to pay off, or you die and it does not go to your heirs. That's the problem with reverse annuity. All right, Muhammad just wrote. Oh man, thanks. I appreciate that. You're a really great instructor. I learned from you more than the school I paid for. That's always a good thing. All right, I appreciate that, man. Glad I can help. All right, the next one is blanket mortgage. And guys, we're really almost done. I'm sorry for keeping you guys longer. Blanket mortgage is for subdivisions. That's what you need to remember. Subdivisions or developments. Why? Because it covers the whole land. And as you subdivide, as you cut and sell it, right? The bank is not saying, hey, due on sale. You guys remember due on sale clause, anybody? Who can tell me what's the due on sale clause? The mortgage. Antar, yes. So an annuity, that's what it is. Until you die, you keep on getting paid. Yep. But then you lose the property. It doesn't go to your heirs. All right, Joanna says pay in full. That's right. So when it changes ownership because you sold in installments, you sold the property, right? When you lose that parcel's ownership, you don't have to pay off the whole loan. The blanket mortgage allows you to pay in installments. So as you sell a parcel, you pay the bank. You sell another parcel, you pay the bank without having to pay the whole thing. What you got to remember again, blanket mortgage is for subdivisions or developments. All right. And guys, if you want more information, there's information here, links for FHA loans, VA loans, HUDs, and so on. That was tough. All right, guys, if you have any questions, make sure you reach out to me. If you have any questions right now, I'll stay here a little bit longer. If anybody wants to leave, it's fine. I'll stay a couple more minutes. If you have questions related to this chapter, I will explain. YouTubers, if you have questions while we're live, take advantage. If not, you guys got my number, 908-418-8325. It's always better to reach me on WhatsApp. All right. If anybody has a question, put a question mark right now in the Zoom chat so I know if I should close this. All right, Carly. Okay, bye. So I just know if you guys have questions or not, and I'll wait a little bit longer. Thank you, guys. All right. Everybody leaving. Great. Awesome. No questions? Cool. Can you start testing, Edith? Yeah. Can. And next Saturday we have the school exam. All right. So you can do the online test that we have on the student portal, and next Saturday we have the. All right, guys. If there's no questions, I'll see you tomorrow either at 10 a.m. if you join the morning class, or 5:30 if you're joining the evening. Thank you, guys. Good night.